You know what genuinely keeps me up at night? It's not the stock market. It's not interest rates. It's not even the national debt. And trust me, the national debt is terrifying. What keeps me up is how many people right now are sleeping just fine, totally convinced that we beat inflation. Convinced it's over, done, finished. And I get it, I really do. The headlines have been a lot friendlier lately. The Fed has been practically patting itself on the back. And if you only read the surface-level financial news, you'd think we just walked out of a burning building, dusted ourselves off, and everything is totally fine. But here's what I need you to understand today. Celebrating the end of inflation right now, is exactly like celebrating the end of a horror movie before you've actually checked the basement. You know that scene. The music swells, the monster is supposedly dead, the final girl catches her breath, everyone in the theater starts relaxing, and then, boom, the sequel starts. The hand reaches up from the floor. That's where we are. That's exactly where we are in this economic story. And by the end of this video, I'm going to show you historical data, real numbers, and economic mechanics that the mainstream financial media desperately doesn't want to complicate their simple, click-friendly narrative with. So let me ask you something right up front, and I genuinely want you to sit with this question for a second. Do you actually feel like things are cheaper than they were 3 years ago? Do your groceries cost less? Your rent? Your car insurance? Because if the answer is no, and I'm betting it's no, then maybe the victory they keep announcing isn't quite what they're making it out to be. Stay with me. This one's going to change how you see the economy entirely. All right, let's go back in time. And I know, people's eyes glaze over the second you say the 1970s. It sounds like your dad's boring economic war stories. But I need you to fight that impulse, because what happened in the 1970s is not just history. It is a blueprint, a warning. And right now, we are following that blueprint almost page by page. Here's the condensed version. In the late 1960s and into the early 1970s, America ran extremely loose monetary policy. Government spending exploded. Vietnam War, Great Society programs, all of it happening simultaneously, and the Federal Reserve basically printed money to keep up. Inflation started climbing, slowly at first, then fast. By 1974, the Consumer Price Index was running at over 12% annually. Think about that. Prices rising by double digits every single year. Your savings account getting quietly, systematically gutted month after month while you went to work and tried to keep your head above water. Now here's the critical part, the part that is actually directly relevant to us right now, today, in this moment. The Federal Reserve panicked. They tightened monetary policy aggressively. And it worked, sort of. Inflation started cooling down. By 1976, it had dropped significantly. And everybody, Wall Street, the government, regular people sitting around their kitchen tables let out this enormous collective sigh of relief. The worst was over. Or so they thought. And here's my question for you. Has anyone in your life been telling you lately that the worst of inflation is behind us? Because that's exactly what they said in 1976, word for word. The same reassurances, the same soft landing narrative, the same financial media telling everyone to relax. What happened next is the part that should genuinely frighten you. The Federal Reserve, seeing that inflation had cooled, shifted to what economists call a dovish monetary policy. Translation, they started cutting rates. Money got cheap again. Credit started flowing freely. And the embers of inflation, which everyone thought were cold, they weren't cold. They were just waiting, smoldering just below the surface, invisible to anyone who wasn't paying very close attention. By 1979 and 1980, inflation had come roaring back, not at 4 or 5%. We're talking 14.8% inflation in 1980, the worst in modern American history. It took a Federal Reserve chairman named Paul Volcker essentially breaking the economy on purpose, raising interest rates to nearly 20% to finally kill it for good. Unemployment skyrocketed, we had a brutal double-dip recession, small businesses collapsed, families lost homes, and millions of ordinary Americans had their financial lives absolutely destroyed, not because they made bad decisions, but because they trusted the people who told them the monster was dead. So I want you to look at that timeline and then look at where we are right now. Inflation peaked. The Fed tightened. Inflation cooled. Now the conversation is dominated by talk of cutting rates. Does any of that sound familiar to you? Because it should. Because we are standing almost precisely where America stood in 1976. And the people who were standing in that exact same spot in 1976 had absolutely no idea what was coming for them. So now let's talk about today, right now. Because you turn on the financial news and what do you hear? Soft landing, resilient economy, inflation tamed, rate cuts on the horizon. It's like a financial lullaby, very soothing, very carefully designed to keep you relaxed and your money exactly where the institutions want it sitting. And look, I'm not saying everyone delivering that message is lying to you deliberately. Some of them genuinely believe it. But I am saying that the incentive structures of mainstream financial media are deeply structurally aligned with keeping you calm, keeping you invested, and keeping you consuming content that makes you feel like the experts have everything handled. And that is not the same thing as telling you the truth. Those are two very different things, and it's important you understand the difference. Here's an analogy that I keep coming back to because I think it captures the current situation perfectly. The United States government spending habits right now remind me of a guy going through a midlife crisis, swiping his credit card on a brand new sports car, leather seats, panoramic roof, the full package, while his mortgage is quietly sliding into default in the background. The car is real, the payments are real, the joyride is real. The problem is that nobody in the room wants to be the one to stand up and say, "Hey man, I think we need to talk about the mortgage." Or think of it this way. You know that person on a first date who spends the entire evening calling themselves a visionary entrepreneur with multiple ventures in the pipeline? And then you find out they sell solar panels door to door? Look, there is genuinely nothing wrong with selling solar panels, but there is something deeply wrong with the presentation and the reality. And right now, the economy's official presentation and its actual underlying reality are separated by a massive, quietly terrifying gap that nobody in a position of power seems particularly eager to discuss. Because here's what's actually happening underneath the surface, underneath the optimistic headlines. American consumer debt is sitting at record highs. Credit card delinquencies are climbing back toward levels we haven't seen since the 2008 financial crisis. Commercial real estate is in serious, widespread distress. Regional banks are sitting on portfolios of assets that are underwater by billions of dollars. And the federal government is running deficits so large that it has to issue trillions of dollars in new debt every single year just to keep basic operations running. So let me ask you honestly, and I really mean this, think about it before you answer. Does that sound like a victory to you? Does that sound like an economy where the war on inflation has been decisively won? Because to me, it sounds like someone declared victory, issued a press release, and quietly left the battlefield still on fire. Okay, let's get into the actual mechanics of how a second wave of inflation develops. Because this isn't just vibes and historical comparisons. There are specific, identifiable, documented financial processes that cause it. And once you understand them, you'll start recognizing the warning signs in real time every time you read the news. Step 1 is what I call the illusion of victory. This is the phase we are in right now. Headline inflation cools, the Federal Reserve starts hinting at rate cuts, Wall Street throws a party, markets go up, everybody posts their gains. And critically, the political and institutional pressure to maintain tight monetary policy starts to evaporate. Nobody wants to be the one keeping rates high when the economy looks like it's recovering. There's enormous pressure from both markets and politicians to ease up, to give people some relief, to let the economy breathe. That impulse is completely understandable, and it is exactly how the second wave begins. Here's the thing about that rate cut conversation that almost nobody in the mainstream media explains properly. When the Fed cuts rates, it isn't simply making mortgages slightly cheaper for home buyers. It's making money itself cheaper. It's sending a signal to every bank, every hedge fund, every private equity firm, every leveraged investment vehicle on the planet that the cost of borrowing has just gone down. And cheap money across essentially every historical episode we can study does one very predictable thing. It inflates things. Step 2 is what I'd call the hidden mechanics, the stuff that happens deep in the financial plumbing that never makes the evening news because it requires explanation, and explanation doesn't get clicks. When rates come down, you get a massive expansion of what's called the private credit market. Private lenders step in and begin extending credit to companies and borrowers who can't necessarily get traditional bank loans. This sounds neutral on the surface. It isn't. It's injecting enormous amounts of new money into the economic system, money that then chases goods, services, and assets, pushing prices up in the process. Simultaneously, you get something called the cross-currency carry trade kicking back into high gear. This is where large investors borrow money in a country with low interest rates and invest it somewhere they can earn higher returns. It's a global game of borrowing cheap and buying expensive, executed at a scale that most people can barely comprehend. And when it works, it generates enormous profits for the people running it. Until it doesn't. And when it doesn't, it unwinds with terrifying speed, and the damage spreads across the entire global financial system. What both of these mechanisms share is that they're fundamentally built on one specific assumption, that there will always be someone willing to buy what you're holding at a higher price before the music stops. Economists don't call it that in their papers, but that's what it is. Gambler's ruin, executed at a macroeconomic scale. Everyone borrows and buys, confidently assuming they won't be the last one standing when it all falls apart. And here's the question I want you to genuinely sit with. Who do you think ends up holding the bag when the music stops? Is it the hedge funds who designed these trades and have entire risk management departments? Is it the institutional investors with armies of lawyers and decades of experience navigating financial crises? Or is it the retirement accounts, the savings accounts, the working people who simply trusted that the system was functioning the way it was supposed to? Step 3 is the actual second wave itself arriving. All of this new liquidity, all this cheap money flooding back into the system has to go somewhere. And it goes into prices. Not just asset prices, though those go up too and create their own problems. It goes into the prices of actual, physical, real-world things that you buy every single week. Food, energy, rent, healthcare, car insurance. The things that don't appear in Wall Street's highlight reel, but absolutely dominate the financial reality of working people across this country. And here's what makes the second wave so much more dangerous than the first wave. By the time it arrives, everyone has already let their guard down. The conversation has moved on. People have made major financial decisions, bought homes, taken on significant debt, changed jobs, adjusted their saving strategy, all based on the assumption that inflation was definitively defeated. The second wave of inflation, when it comes, does not hurt everyone equally. Let me be very direct about that. If you own significant assets, a large real estate portfolio, a substantial stock portfolio, investments that are structured to track inflation, you are somewhat protected. Inflation, in many ways, inflates your assets right alongside everything else. It's uncomfortable, but it's navigable. You have buffers. You have options. But if you are living paycheck to paycheck, if your net worth is primarily sitting in a savings account, if you're renting in a market where landlords can and absolutely will pass every inflationary cost directly onto you the moment your lease comes up for renewal, you get crushed, quietly, methodically, without a single cable news headline being written about your specific situation. Inflation is, at its core, a hidden tax. It doesn't show up on your W-2, it doesn't arrive with an invoice, it just quietly, patiently erodes the purchasing power of every dollar you've managed to save, every hour of work you've ever converted into money in your bank account. And here's what I find most troubling about the current moment. It's already happening. The first wave never actually went away for most people. The price of eggs, the price of car insurance, the price of childcare and healthcare, and a basic night out. These didn't come back down when headline inflation cooled. They just stopped going up as fast. And that is not relief. That is not recovery. Not even remotely close. So here's my question for you, and I want you to actually answer this in the comments because I do read them. Are you actually feeling financial relief right now? Real, tangible relief? Or does it feel more like you've just slowly gotten used to a higher cost of living because you didn't have another option? Because there is a critical difference between economic recovery and economic adaptation. Recovery means things actually got better. Adaptation means you lowered your expectations to fit a harder reality and stopped noticing how heavy it's gotten. And I genuinely believe that a lot of people right now are being told they're experiencing recovery when what they're actually experiencing is adaptation and being gaslighted into thinking those two things are the same. Now, I also want to address something that drives me genuinely crazy when I see it, and I see it constantly right now, especially in online financial communities. When people feel their money losing value but don't fully understand why, they become vulnerable. They become desperate for something, anything that will outpace inflation and give them back a sense of control. And that desperation gets exploited by meme coins with elaborate white papers, by viral investment schemes wrapped in financial jargon, by Discord servers run by teenagers with impressive-sounding vocabulary and absolutely zero accountability for what happens to your money after you send it to them. I've watched people pour money they genuinely couldn't afford to lose into wildly speculative assets because someone with a good camera and confident body language told them it was a hedge against dollar devaluation. Sometimes it works out. Far more often, it doesn't. And the people who designed those trades were very deliberately counting on retail investor desperation to serve as their exit liquidity, meaning you are the last person holding the bag when the whole thing collapses and they've already cashed out and moved on. Please stay grounded in data. Understand the real difference between speculation and genuine inflation hedging. Real estate with positive cash flow, commodities, treasury inflation-protected securities, internationally diversified equity portfolios. These are boring, they don't go viral, they don't have their own hashtag or their own subreddit with rocket emojis, but they have decades of historical evidence behind them, and when the second wave comes, that evidence is going to matter infinitely more than any influencer's endorsement ever could. I don't want to leave you simply scared. Fear without information is useless. So let's talk about what to actually watch for, because the second wave, if and when it comes, will not announce itself with a press conference. It will creep in quietly and build momentum before most people realize what's happening. Here are the specific indicators I'm personally tracking very closely right now. First, shelter costs. Housing-related inflation was actually significantly understated during the first wave because of the way the CPI measures it. It uses a lagging indicator called owner's equivalent rent that takes a long time to reflect what's actually happening in the real market. When that number starts climbing again in the data, it's one of the most reliable signals that underlying inflationary pressure is rebuilding beneath the surface. Second, wage growth relative to productivity. When wages grow faster than worker productivity for a sustained period, businesses are forced to pass those costs directly to consumers through higher prices. Watch the Bureau of Labor Statistics reports on this. When that gap widens consistently, prices reliably follow. Third, energy prices. Oil and natural gas are what economists call inflationary multipliers. They affect the cost of virtually everything downstream: manufacturing, transportation, food production, heating. When energy prices spike and stay elevated, the ripple effects touch every corner of the economy. And this is not a new insight. The 1973 oil embargo was literally one of the primary triggers of the entire 1970s inflation spiral we talked about earlier. Fourth, and this one is subtle but genuinely important, consumer inflation expectations. The Federal Reserve Bank of New York runs a monthly survey of consumer expectations that tracks where people expect inflation to be in 1 year and 3 years out. When those long-term expectations start anchoring at higher levels, it becomes a self-reinforcing cycle. People demand higher wages to compensate for expected inflation. Businesses raise prices to cover those higher wage costs, and the whole mechanism feeds itself. The Fed watches this data obsessively, because once expectations become unanchored, fighting inflation gets dramatically harder and more painful. Are you watching any of these indicators right now? If not, you probably should be starting. And if there are metrics you're personally tracking that I haven't mentioned, drop them in the comments. I genuinely learn as much from this community as I hope you're learning from me. So here's where I want to leave you today. I am not here to tell you the world is ending. It isn't. Economies have faced second waves of inflation before, and societies have navigated them. Carry yourselves, stay skeptical, and I'll see you in the next one.